Most people who buy stocks have absolutely no idea if they are paying a fair price. They see a stock trading at $10 and think it is cheap. They see another stock at $500 and think it is expensive. But here is the truth. The price of a stock tells you absolutely nothing about its value. A $10 stock can be outrageously overpriced. A $500 stock can be a genuine bargain. Today, we cover the single most important metric every investor needs to understand before buying any stock: the price-to-earnings ratio, the PE ratio. By the end of this video, you will know exactly how to calculate it, what it actually means, how to use it correctly, and the critical mistakes most beginners make when they misread it. Stay with me, this one is fundamental. Let us start with the formula, because it is simpler than most people expect. PE ratio equals stock price divided by earnings per share. That is it, two numbers, one division. Let me make this concrete with a real example. Imagine a company whose stock is trading at $50 per share. That company earned $5 per share in profit over the last 12 months. 50 divided by 5 equals 10. The PE ratio is 10. Now here is what that number actually means. A PE of 10 means you are paying $10 for every $1 of annual profit the company generates. Another way to read it, at the company's current earnings level, it would take 10 years of profits to earn back what you paid for the stock. This is why the PE ratio is also called the earnings multiple. You are paying 10 times the company's annual earnings. Now imagine a different company, stock price $100, earnings per share $2, PE equals 50. You are paying $50 for every $1 of annual profit. At current earnings, 50 years to earn back what you paid. That is a very different proposition from PE 10. And this is exactly why the price of a stock alone is meaningless. The $50 stock at PE 10 is, in this example, far cheaper in real terms than the $100 stock at PE 50. Price is what you pay, PE is what you get for that price. Now let us talk about what high and low PE ratios actually mean in practice. Generally speaking, a low PE ratio suggests a stock may be cheap or undervalued. A high PE ratio suggests a stock may be expensive or growth-oriented. But here is the most important lesson in this entire video. A low PE is not automatically a bargain. A high PE is not automatically overpriced. Context matters enormously. Let me explain why with two examples that make this viscerally clear. Example 1, Company A PE of 8 sounds cheap. But Company A is a coal mining business. Revenue has been declining for 5 years, the industry is shrinking, competition is destroying margins, earnings next year will likely be lower than this year. A PE of 8 on a declining business can actually be expensive. You are paying 8 times earnings that are about to shrink. Example 2, Company B PE of 40, sounds expensive. But Company B is a software business growing revenue at 30% per year. It has dominant market share, high switching costs, expanding margins. Earnings this year are 10 times what they were 5 years ago. A PE of 40 on a high-growth compounding business can actually be cheap, because you are paying 40 times today's earnings, but tomorrow's earnings will be dramatically higher. This is the fundamental insight that separates investors who understand valuation from those who just chase low numbers. The PE ratio only tells you what you are paying relative to current earnings. It says nothing about what earnings will look like in 3, 5, or 10 years. And for a growing business, future earnings are what actually matter. This is why growth companies command higher PE ratios. The market is pricing in expected future earnings growth. A PE of 30 on a company growing earnings at 25% per year can be a better investment than a PE of 12 on a company growing earnings at 2% per year. Now let me give you the real-world industry context you need to use this correctly. Because one of the most dangerous mistakes beginners make is comparing PE ratios across completely different industries. A bank with a PE of 8 is not cheaper than a technology company with a PE of 35. They are simply different businesses with completely different growth profiles, risk levels, and earnings structures. Here is the current picture by sector. Technology companies typically trade between 25 and 40 times earnings. As of early 2026, the information technology sector PE sits around 40. High, but reflecting strong expected earnings growth from AI, cloud computing, and software. Financial companies like banks typically trade between 8 and 15 times earnings. Banks grow slowly and are sensitive to economic cycles. Lower growth means lower multiples. Consumer staples companies, food, beverages, household products, typically trade between 18 and 25 times earnings. Slow and steady growth, predictable earnings, moderate multiples. Energy companies typically trade between 10 and 18 times earnings. Earnings are volatile because they depend on commodity prices. Utilities typically trade between 15 and 20 times earnings. Very stable earnings, very predictable, low growth. Healthcare typically trades between 20 and 25 times earnings. The key principle is this: never compare a PE ratio across sectors. Always compare a company's PE to its own industry average and to its own historical PE range. A technology company with a PE of 20 may look expensive compared to a bank, but may actually be very cheap compared to its own history and its sector peers. Now let me explain the three types of PE you will encounter, because they are not the same number and they measure different things. Type 1, Trailing PE. This is the most common version. It uses the actual earnings from the last 12 months, real reported numbers, not estimates, not projections. The advantage: it is based on what actually happened. The limitation: it looks backward. If the company just had an unusually good or bad year, trailing PE can be misleading. Type 2, Forward PE. This uses analyst estimates of earnings for the next 12 months. The advantage: it is forward-looking, more relevant if you believe the estimates are accurate. The limitation: estimates are often wrong. Companies miss or beat projections constantly. When you see forward PE significantly lower than trailing PE, it means analysts expect strong earnings growth ahead. This can be a signal worth investigating. Type 3, Shiller PE, also called CAPE. Cyclically adjusted price to earnings. This uses average earnings over the last 10 years, adjusted for inflation. The advantage: smooths out short-term earnings spikes and crashes, gives a longer-term valuation picture. It is primarily used to assess whether the overall market is cheap or expensive, rather than individual stocks. The historical average CAPE ratio is approximately 17. When CAPE goes well above 30, the market has historically been considered expensive by this measure. Now let me walk you through the 4 most common mistakes beginners make with the PE ratio. Mistake 1, buying a stock simply because its PE is low. A low PE can mean a stock is undervalued, but it can also mean the business is genuinely struggling, the industry is in structural decline, or there is a serious problem the market already knows about. A low PE is a signal to investigate further, not a reason to buy automatically. Mistake 2, ignoring a negative or missing PE. When a company has no earnings or negative earnings, it has no PE ratio, or the number is shown as negative. This happens frequently with early-stage growth companies. It means the business is not yet profitable. Investors are betting on future earnings, not current ones. Buying a company with no PE is not automatically bad, but you need to understand what you are actually paying for. Mistake 3, not checking if earnings are real. Earnings can be manipulated through accounting choices. A company can report high earnings per share through one-time items, asset sales, or accounting adjustments that will not repeat. This is why many sophisticated investors look at cash flow statements alongside PE. We will cover this in detail in next week's video. Because profit can be manufactured on paper, but cash flow is much harder to fake. Mistake 4, using PE as your only metric. PE is powerful, but it is one lens, not the whole picture. A complete analysis combines PE with revenue growth rate, profit margins, debt levels, return on equity, and cash generation. PE tells you the price you are paying relative to earnings. Other metrics tell you the quality of those earnings and the sustainability of the business. Let me give you a simple practical framework for using PE correctly. Step 1. Calculate or find the PE ratio of the company you are analyzing. Step 2. Find the average PE of its industry sector. Compare the company's PE to its peers. Is the company trading at a premium or discount to its sector? If premium, why? If discount, why? Step 3. Find the company's own historical PE range over the last 5 to 10 years. Is the stock cheap or expensive compared to its own history? Step 4. Look at the earnings growth rate. Is the PE justified by the growth? A rough rule of thumb, a PE roughly equal to the earnings growth rate is considered fairly valued. This is the foundation of what is called the PEG ratio, which we will cover in a future video. Step 5. Ask what would have to be true for this PE to be justified. If a stock trades at PE 50, what earnings growth rate would you need to make that a good investment? Is that growth realistic given the company's history and industry? This kind of thinking separates disciplined investors from those who simply react to numbers. Quick recap of everything we covered today. The PE ratio equals stock price divided by earnings per share. It tells you how much you are paying for every dollar of annual profit. A PE of 10 means you pay $10 for every $1 of earnings. A PE of 50 means $50 for every $1 of earnings. Low PE does not automatically mean cheap. High PE does not automatically mean expensive. Context and growth expectations determine whether a PE is justified. Industry matters enormously. Technology trades around 40, banks trade around 8 to 15, consumer staples around 18 to 25. Never compare PE across sectors. 3 types of PE: trailing based on past earnings, forward based on estimates, and CAPE based on 10-year averages. 4 mistakes to avoid: buying just because PE is low, ignoring missing PE, not checking if earnings are real, and using PE as your only metric. The PE ratio is your starting point in stock analysis, not your ending point. Drop a comment below. What stock or sector are you currently analyzing? I want to hear what you are looking at. I read every single comment and reply to as many as I can. If this gave you clarity that changes how you look at stocks, please hit the like button right now. It takes 2 seconds, and it genuinely helps this channel reach more people who need this. Now before you go, here is something important. The PE ratio tells you what you are paying relative to reported earnings. But here is a question that every serious investor needs to ask. Are those earnings real? Because companies can legally report strong earnings on paper, while the actual cash coming into the business is falling. Next week on Income Decoded, we are going to cover the one financial statement that separates the businesses that are genuinely healthy from the ones that just look good on paper. The cash flow statement, and why sophisticated investors always look at cash before they look at earnings. If the PE ratio video opened your eyes, next week we'll take your analysis to a completely different level. Hit that red subscribe button right now and turn on the bell. Because next week we follow the cash. I will see you then. Stay focused, stay consistent, and remember, price is what you pay, value is what you get. The PE ratio is how you tell the difference. Let us go.